Hello and welcome back to the Financial Secrets Revealed podcast, where we are in collaboration for this mini-series with Allan Gray Funds. Now, today I am joined by the fabulous Simon Mawhinney, which sounds terribly Irish, but Simon, you sound a little bit South African. So how did that work?
Yes, so both my parents are from Northern Ireland, and at some stage in the mid to late 1970s, my father was made redundant, and our family moved when I was very young to South Africa, where he could find employment at the time as an engineer, and I ended up growing up there, and that's the accent. But yeah, the surname obviously very Irish.
Yeah, very. Cape Town, that was the part of South Africa you're in?
Well, we moved around a lot, what in Australia people would refer to as whoop whoops. As an engineer, my father did move around quite a bit, and I ended up going to school in Pretoria, a boarding school from a young age for that very reason, so as not to change schools.
Right.
And then I went to university in Cape Town, so a bit all over actually.
No, very beautiful country. I haven't been back for a very long time, but I do remember with great fondness the beautiful Table Mountain and Lion's Head, and I ducked over to Durban as well to see friends for a couple of days. So, yeah, very beautiful, just not quite as safe as we're used to here, unfortunately.
Yeah, that's right.
Now, your official title is Managing Director and Chief Investment Officer of Allan Gray Australia. And so you're the one responsible for the investment strategy and overseeing the performance of the fund. So you think of yourself more of an analyst, I'm guessing.
Yes, I do. I think every firm needs a single throat to choke, and that's what the other title refers to. But yeah, that would be me. But yeah, I am just one of 9 people on the investment team, and we are all first and foremost analysts.
Excellent. Now, I believe you became a little bit famous recently for a quote you made regarding the CBA share price. What brought that on, that you would rather stick pins in your eye than buy CBA at the current price, which I kind of agree with, unfortunately.
I didn't realize that Stardom had followed that soundbite, but yeah, I can't remember where I said that, but I did say that, and it was as a result of the then and still now elevated share price of CBA, which we can't really understand, and we definitely can't make work. But someone had, I think, suggested that we incorporate it into our portfolio to reduce the risk of the portfolio. And I think, well, that would do exactly the opposite.
Absolutely, when it's at such an all-time high. I believe the record high makes it one of the most expensive banks in the world at the
yes, moment. And it still is the most expensive bank in the world. It's ludicrous. And the worrying thing is, actually, it's not the most expensive company in the stock market. There are companies like Wesfarmers and Goodman Group that eclipse CBA's share price. So, in terms of underlying fundamentals, so there are the big part of our stock market is very elevated and worth some caution when it comes to allocating capital that way.
Well, that's probably a great segue into Allan Gray's been known to be a contrarian investor, and we've done a bit of a deep dive with LJ into what that means. So can you explain how that influences how you manage funds?
Yeah, okay. I wouldn't, not having listened to or seen LJ's portion and description of what being contrarian means, but I would say we're not contrarian for contrarian's sake. We are fundamental bottom-up stock pickers, but we typically find that companies for which there is quite a lot of blue sky in terms of growth potential, where there aren't obvious hurdles or storm clouds brewing, can be priced for perfection. And it is there that the risks are likely greatest. And on the other side of the spectrum, the companies that are undergoing some deep cyclical drawdown or have shot themselves in the foot, not in a way that's terminal, where the bad news is known and priced in to the point where the future is expected to be woeful. Those companies present the best upside, because even if the future is just bad, you end up doing quite well. And so that's where we focus on, and most of it is cyclical in nature, and people can't see catalysts. The problem is when you see the catalyst or the catalyst presents, it's too late. So we typically are early, and it's a little painful sometimes, but that's what it really means to us, and that's where we focus on deep cyclically impacted companies that trade cheaply.
So what you would often be doing then, I'm guessing, is going against the herd, or the mentality of, everyone's piling in on things. Are there times when you've had to really hold your nerve when it looks like it's all going to hell in a handbasket and you're like, no, I've got absolute conviction that this will turn around and do really well for our investors? Has that ever happened?
Yeah, it's happened a lot. It almost happens all the time. I would just categorize it slightly differently, because I don't think it makes sense to have absolute conviction, because that absolute conviction can lead to overconfidence, which that becomes arrogant, and that is the kiss of death when it comes to investing, particularly with our style. So I do think it makes a lot of sense to question what we are doing. To think about where we might be wrong, because on the other side of every trade we do is someone likely smarter than us doing exactly the opposite thing. So they've got a different perspective to us, and trying to understand what it is exactly that they see or don't see that we are taking the other side of, and being patient. And, if you can't, if you take a more academic view of the world, and if you can't disprove your thesis, then it's true, rather than going out to try and prove that you're right and swinging the bat hard. So we try and prove we're wrong first. And that's sort of, but yes, a lot of it is going against the tide. We've had Metcash in 2015. That was a very good recent example. The COVID drawdown, where everything was going bankrupt seemingly, and we underperformed leading into that. We weren't ideally positioned in the lead up to COVID, that's for sure. If I had my way again, and I would not have been in the companies we were in, but COVID was sprung upon us somewhat. But there came a point where the market and various things in the market were priced for perfection, as I was saying earlier, and no one seemed to bother to think that we live in an ecosystem where there are interdependencies and codependencies amongst lots and lots of different companies. And we're almost in that position now. And those are good times to lean heavily into the things where there are strong signs of fundamental upside.
So as an analyst, your mantra is basically that you've got to stay grounded when everyone's super euphoric. I mean, the markets have done very well for quite a while. People getting their super statements and they're looking good before you throw them in the drawer. People start getting excited about, markets have been doing well for quite a while. Maybe I should, start going in. So when we're starting to hit this euphoria, I'm usually the one going, maybe now's not the time. How do analysts stay grounded and make those decisions when, other people are thinking that, like you said, the complete opposite of what you're doing, whether it's, the herd or other analysts?
Yeah, well, I'm trying to come up with a good answer for that doesn't sound like marketing bollocks. But I mean,
bollocks it is.
One thing I could say is the funds are the very place the investment team puts their own money. I'm not allowed to invest in shares directly, Australian listed shares. And so the only way to get exposure to our market is to go through either other fund managers or our own fund. And, we choose our own funds. And it does feel at the moment now like we are having this white tablecloth dinner on top of an active volcano. Everything is just great. The food's wonderful. The company's great. But there does seem to be some rumblings brewing, and it's always the bus you don't see that kills you. And when it feels that way, it's just a natural inclination to try and gravitate towards things that are would offer more protection in the event that the volcano erupted, and it's just part of the philosophy and sort of the process. It sort of comes naturally to the investment team. We look at it now and we see that there is, and it's a mathematical certainty, the stock market upside today is less than the stock market upside was a year ago, quite substantially less, because we're now that much higher than we were a year ago. And I think there are times over the last 20 years where I've felt I would far rather miss the next 10% share price upside than fully participate in the next 20% downside. And now's one of those. And so, I mean, that's sort of the footing and the setting that we're on at the moment.
So risk is obviously a big part of the investment process, especially when you're looking at shares. So is that part of how you think about risk and integrate the management into the investment process for your funds?
Yeah, so that we look at risk through quite a few lenses, but none of them seem typical to how others think about it. Most people think about risk as tracking error. We think about risk more as risk of permanent loss of capital in an inflation-adjusted sense, so in real terms. And if I was more worried about tracking error, I would own some of these very expensive high constituents or large constituents in the market, like Wesfarmers, like CBA, Westpac and NAB and Goodman Group, none of which we own. Not just don't own, or not just are underweight. There's not a single share in any of those companies in any of our funds, because our risk settings say that that's where the likely permanent loss of capital will come from. And so we would like to generate real returns for our investors over a sustainable period, and that is typically how we think about risk. And if what is a reasonable return? Well, over the last 120 years, our stock market's returned about 7% real. But over 1,000 years, no one in the world has invested 7% and achieved a 7% real return. Because if you invest $1, or let's say $4, a cup of coffee, I don't know, you're in Brisbane, I think. Yeah, let's say $8.
That's without the fancy milk.
Yeah. At 7% real for 1,000 years, you would have more than the entire stock market capitalization of the world today. And so, it hasn't been done for 1,000 years. It has been done for the last 120. It's not clear what the next 120 years will be like, but at some point, 7% real is going to be stellar. And if you can find something that you think would deliver that, go for it. But shooting for 10 or 15% real is crazy. And that's the kind
Everybody wants that. Come on.
Yeah, I know. Yeah. And very few will get it. No one will get it sustainably, right? So, so risk is multifaceted for us. We've got all the risk systems that everyone else has. We do go through them. We think about liquidity as well. Margins of safety are important to us. Upside, downside scenarios. We overlay 20 or 30 of the biggest stress events on our portfolio. So we would look at the financial crisis and what the likely impact would be on our portfolio. COVID, we would see the drawdown potentials, where it is. And then we either accept that risk or not. But if you're not happy to accept some risk, you need to invest in the benchmark, and the benchmark for us is the height of mediocrity. People can do that on their own and pay very, very low fees.
What index funds are for, yeah.
Exactly.
So we want to do a bit more of a deeper dive on the balanced fund that Allan Gray has in Australia. So how do you work out your asset allocation for that fund, especially when, you've said we might be sitting on the volcano at the moment. There might be uncertainty ahead. So is your allocation a bit more movable at this stage? How does it work?
Yeah, well, the clean sheet of paper is 60% of the balanced fund is invested in equities. And then that 60% is split 60% Australia, 40% globally. And the other 40% is invested in fixed income. Again, a 60-40 split between Australia and global. But that is the clean sheet of paper, and you can deviate quite significantly on either end of that. So you can have the equity weight fall below 60%. It happens to be below 60% now, which given what I've said and the volcano and all of that stuff is probably not surprising. But actually, when we look at the positions, the equity positions in there, and they look absolutely cheap and relatively astonishingly cheap. And so I would say the equity weight's around 58%, but that could go down quite low if we struggle to find cheap companies. We've been heading more towards some of the more cyclical companies that have been very heavily sold down in the balance fund. And on the 40% fixed income side, some of that has been in. We've used some of that to fund a gold position. We've had that for quite some time, and that's done reasonably well. And we have been reducing that. And we've been short duration, and we're worried about inflation. So a lot of it is in TIPS, Treasury inflation protected securities. So it's a mix, but we think that the equity stocks that we have invested in present very cheaply in an absolute and relative sense. So it's difficult to take our equity exposure when we have that opportunity set much below the 58% it's at the moment.
Well, that's a very, I guess, simplistic, you've got your 60-40 rules, how it works. There must be some challenges when you're trying to strike that right balance, protecting capital like your growth allocation versus your gold allocation. What sort of things do you use? Is it market timing? Have you got hedging? You've got that flexibility you spoke about. How do you handle those challenges of getting it right?
Yeah, well, we have it's Fight Club. It's all of the people involved fighting to have their right.
We're not allowed to talk about Fight Club.
This is not that Fight Club.
Okay.
But yeah, there are a lot of people competing to have their best ideas into the balance fund, and we spend a lot of time arguing about what we should prioritize and where what is the upside for each thing. So a fixed income security, if we can find a better equity security, then why do we have 40% in fixed income? If there's, we would far rather have more of that 40% invested in the equity side of things. So, and of course, the upside on a fixed income security is face value. So I think if we can find the risk of downside to be quite low in an alternative security like an equity, and the upside is far greater, we would rather head in that direction. But for everyone, it's let's rank these investments in order of attractiveness in terms of IRR, future IRR, and see where we go. And then let's run these risk models over them and say, what's the end outcome, and where are our exposures? How have we layered exposures on top of each other? So there's me in Australia and there's Alec overseas, and he has like Barrick Gold, for example, and I've liked Newmont, which is listed here. And left to our own devices, he probably would have had 5% of Barrick, and I would have had 5% of Newmont, but 10% in the balance fund would have been too much. Well, not in hindsight, but our risk tool would have said it's too much, and so we've tried to moderate that and try and prioritize the one over the other. We happen to own both and physical gold, but it just comes down to a ranking of return potential from each security.
So the balanced fund you mentioned does have, of their 60% allocation, 40% of that is international shares, and you've got gold. So how do you look after the global side of it and commodity-linked instruments that you've got? How does currency management play out? Obviously, international exposure brings a whole other set of research and parameters. How does Allan Gray go about managing that?
Yeah, so we have a sister company, Orbis, who effectively, and Alec Cutler is the portfolio manager for Orbis's multi-asset strategy, and it's he and his team that do the 40% that is international. We have an identical investment philosophy. In fact, when we started Allan Gray in Australia 21 years ago, we called ourselves Orbis then, and we've subsequently moved to Allan Gray. So we're one in the same company. It's the same philosophy. But Alec, even though, and your introduction was correct, even though I have responsibility for the Allan Gray multi-asset strategy, 40% of that is essentially allocated to Alec. I have a veto right, but it's not the kind of thing I'd choose to use if I could avoid it. And he also does the currency management. And so typically we would only tinker with the currency when things are quite dislocated. It doesn't pay to tinker around the edges when things are 2 or 3% away from where you think fair value is. Even 5 or 10% may not be enough. But some of the things that we do have currently are essentially a zero weight to the US dollar, a slightly overweight to the Australian dollar, and Norwegian krona and a few others, the yen, etc. But yeah, it will depend. I mean, we have our own currency models. We know what purchasing power parity looks like. We have some long-term views, but it would have to have reasonably significant deviations from our assessment of normal to position the portfolio away from a benchmark. So we don't try and tinker around at the edges, as I was saying. Certainly not neither on equity allocation nor on currency. But there are times where, for example, now is likely to pay to be underweight US equities, underweight the US dollar, and underweight or zero weight to some of Australia's biggest equity constituents. It's quite dislocated.
Scottsdale next month, is my Aussie dollar going to finally start buying me a bit more of the US?
Next month, yeah, exactly. Well, already it's done a little bit better, but anyone knows. I mean, next month I'm not sure, but if you go in 2 years' time, I think you'd be in for a treat. Yeah.
So you've talked again about this 60-40. Obviously, that's not a rigid set in stone approach to the fund. How much leeway do you have to be able to make those decisions, which I guess is fundamentally different to some other balanced funds who must stay within certain ranges?
Well, we have ranges, but those ranges are quite wide. You're right. And so I think the best way to answer that question is say we have a lot of flexibility. But we would only utilize that flexibility when the opportunity set presents so attractively such that the skew made sense. I think there are a lot of risks out there at the moment, and it makes a lot of sense. You know, if I think about that 40% being fixed income, it makes a lot of sense having a decent amount there at the moment so that if something happens elsewhere, you're in a position to move. But yeah, I mean, I obviously don't manage a traditional 60-40 balance fund, so it's not totally clear to me exactly how they construct themselves. But we don't reweight the balance fund frequently at all. We think about tax as well. Most of the stuff we do is done on an after-tax basis, and yeah, I mean, we would go down to 40-30% equities if we felt that it was justified. It just so, and looking at the market now, you might think, well, why are we not there? And I would say that's a really good question. And the reason for that is that the stock market is, and not just ours, a lot of global stock markets are so dislocated that they only appear as expensive as they do because of a handful or 10 or 20 companies that are ludicrously priced, and the rest of the stuff actually is very attractively priced. And so I think that's where most of the flexibility is, that within each asset class, we have very significant deviation from the underlying benchmark relative to a 60-40 fund.
mean, there's obviously so much going on in the macroeconomic world at the moment. Like you've mentioned, the geopolitical risk. I mean, even on the home front, we're factoring in some interest rate changes. I've heard everything from 2 to 4 cuts, in the coming 12 months, depending on which fund manager you have a chat with for breakfast. There's inflation to factor in. So all that is sort of part of those investment decisions you're making, that you've got that flexibility to be able to react to those conditions?
Yeah, I mean, I think that's true, but I would also caution that with saying I don't know too many really good macro forecasters, and it's one thing getting the macro right, and then it's another thing investing correctly on the back of that, because your probability of getting the first right is low. The probability of getting the first and the second bit is important, correct, is even lower. And a good example is investing in, for example, macro in 2000, you could have said, I think motor vehicle sales in China are going to double in the next 10 years. And I want some broad exposure to that. And I'm going to invest capital altogether behind that. And say, okay, fine. You would have been right. Motor vehicle sales did double over the next 10 years. And then you think, okay, well, if I have this view of this macro view, what's a good thing to invest in? And, one thing you could have said is, let me invest in the platinum group metals, because those are used in catalytic converters for cars. And if motor vehicles are doubling, the demand for platinum group metals will double and the prices will go up, and all of these platinum miners will be amazingly profitable. And you could put all your capital behind those, and you would have lost 95% of your capital. You would have gotten the macro right, but the capital allocation would have had some risks attached to it. And, lots of things happened. Load factors, the amount of PGMs you needed for catalytic converters, fell significantly. Recycling increased, and everyone else saw this macro thing, guess what, and developed a whole bunch of platinum mines. And so I think it's important to peel the onion back a lot. And, the macro might be the outer layer, but there's just so much more. And yeah, if we could, and this sounds a bit trivial, it would be much easier just to go to the middle of the onion and just ignore the macro. And there is an aspect of our philosophy and approach that tries to get to the middle, and whatever the macro is, it's not going to be the thing that scuppers the investment thesis. And that's the ideal end of the spectrum we would prefer to be on. It's not ignore the macro, just make sure that the investment thesis is not predicated on a macro event. But we are, seeing as we're talking macro, we're worried about inflation. And actually yesterday here in Australia, the inflation print was much higher than people were expecting. And it's one of the reasons we have short duration and Treasury inflation protected securities in the balance fund. Maybe inflation comes down to next to nothing and interest rates fall and everyone can afford houses in Australia again. Maybe. But there's a chance it's not like that.
Mm. Can you think of a time, I know you mentioned one earlier, where your engagement with a particular company led to a really good outcome for the fund?
I'm thinking about that. I feel there's quite a few. And in fact, we've just recently engaged with the company, and I think it will lead to a particularly good outcome for the company, but it's too early to say because it hasn't happened. Grief, you've stumped me a bit with that. Most of the companies we invest in, we don't have to roll our sleeves up with. We don't go into the company with a view to agitating for change. It's more something that happens the 5% of the time where we find ourselves a bit wrong-footed. But I don't think that our agitation and working with companies, boards and managements have ever been anything but a force for good. We are a long-term investor. And yeah, so I mentioned Metcash earlier. We did support that company then. And I think that did come right. Well, it definitely did. We did very well out of it. The one I was referring to more recently is Aurora, where, notwithstanding some poor capital allocation decisions of theirs in the recent past, we weren't on the register. We came in after that. The company seems to have done quite a few good things with respect to asset recycling, selling its US business, paying down its debt, putting itself in a position to buy back its shares. And it's changed its constitution, which I think will lead to a governance improvement going forward, and hopefully all companies follow suit. But I think it's actually quite a good company. Ansell is probably a good example where they found themselves terribly wrong-footed on the back of the COVID cycle, where Ansell makes effectively rubber gloves and latex-free gloves, which through COVID, of course, when everyone was imminently going to die from the disease, all of these hospitals bought huge amounts of this PPE, only to find out that they had too much of it, and the risk settings and the public perception of COVID fell away a little bit. And Ansell found that these hospitals essentially drew down their inventory for months and months and months. And Ansell was sort of, their earnings disappeared and their balance sheet came under a little bit of pressure. And yeah, we entered the register, and we got to know the management team and board, and suggested that there's nothing untoward here. It's a cycle. And if they just manage their company in an old-fashioned way, everything would be fine. No need to raise equity, no need to do anything crazy. And that's worked out very well, actually, for Ansell. So, but yeah, off the cuff and shooting from the hip, those are probably the best examples I have.
Is there anything that's influenced your approach to markets and decision making, a book or a concept or something you learned, some particular person?
Yeah, I think two things probably stand out. The one is, first, Simon Mawhinney, who has unfortunately passed away in 2015. He was the one who set up Allan Gray in Australia, and he used to be the chief investment officer of Orbis in London, and prior to that, Allan Gray in South Africa. And he was a deeply contrarian person, and very capable thinker. He was a physicist, and he often tried to look at the next order impacts of things. And I thought that was, well, for me, very impactful, because it was really my first professional experience of managing money, and I learned a lot from Simon. And then in terms of books, and this is going to sound very basic, and I'm going to get the name. Howard Marks from Oak Tree Capital wrote a book called something along the lines of the 10 or 12 most important things. And that is the book I would, put aside Graham and Dodd, security analysis or whatever. It's that book, I think, gives the best and hopefully earliest overview of what it means to make a good investment. And he has written it in a very disarming and understandable way. And I remember reading that book, 20, 25 years ago, thinking it was incredible, 30 years ago. And wow. I recommend that book to anyone who's thinking about investing.
Excellent. I'll put it in the link in the resources to that one. Now, I know you're an avid mountain biker, and you've got two kids, a little boy and girl, and all day your philosophy is going against the grain. Is there anywhere outside of investing that you might do opposite to what other people do?
No, that doesn't work. No, it definitely doesn't work in your personal life. Just think about it. It's a while since
happy wife, happy life applies regardless. You're not going against that.
No, absolutely not. Yeah, that doesn't work. It doesn't work with building bridges, where 99 engineers tell you to use X amount of steel, and one engineer says you need half of that. Well,
Don't go
You
against
don't go with the one. I can't think, and surgeons as well. 99 surgeons are telling you need to do this, and someone says you need to do that. I would be going with the 99.
for sure.
So no.
Don't leave that one. Go with the grain for the rest.
Yeah, that's right. Absolutely. This is why I think it's quite unique, is because there's no other aspect in life where being contrarian pays other than investing.
My dad
And
always said I was a contrary human being, so I don't think he was complimenting me. So to wrap up, Simon, you've done beautifully with us all about the balanced fund. Do you think there's one thing that a lot of people get wrong about investing and wish that they understood a bit better? What would that be?
yeah, I probably need to go with more than one thing, but all of which would be related. I mean, people often think that because a company is a good company, it's a cheap company. We know about Apple, and we've all been into a Coles before, but it doesn't. And we've all been into an IGA, but it doesn't make Coles a good company to invest in, and a Metcash a bad company to invest in. And so, this familiarity bias is very, very dangerous when it comes to investing. And I find a lot of people are far too emotive when it comes to allocating capital than they should be. Actually, I'll stick with that. That's so. The question was, what is the one thing I think people should don't know about investing that they should? Is that yeah?
Yep.
I'm sorry, I'm not trying to be condescending, but I sense that people are way too emotive when it comes to allocating capital, and it's probably because they think that that's a good way to do it. And I don't think that's the case at all. I don't care how much artificial intelligence is going to take over the world, and how many data centers will be needed in Australia and the rest of the world. And coming back to the beginning of the conversation, I would rather stick pins in my eyes than buy next DC. Notwithstanding, it'll benefit from this, but that doesn't mean to say investors in next DC will benefit.
Right. Interesting lessons. And thank you for the new quote, I'm sure.
Well, same quote, new company.
You might start collecting them. Thank you again so much for your time today, Simon. Really appreciate your insights into the Balanced Fund.
You're welcome. Thanks for having me, Amanda.